All right. Good morning, everybody. Right around the world, still waiting on the finalization of tariffs. We continue to get drip and drip information on that front. Big bombshell of news coming out of Europe. Sounds like Marie Le Pen was found guilty. Her entire political party has been found guilty of using funds inappropriately, and she's barred from running for office for 5 years, which messes up the elections. And um, just really big news coming out on that front. NASDAQ down more than 1.75. Small caps right behind it at 1.5. Then the S&P a little more than 1.25, and the Dow, our illustrious blue chips, down 0.75%. Japan down the least. The Chicago Business Barometer PMI has a forecast a few points lower. It might not seem like much, but 2 percentage points in this area, I don't think the market's going to like this too much. We'll see how the numbers actually come out, but this discrepancy here, we may feel that later in the day. That's 9:45. We have a couple of auctions today at 11:30. We have executive orders being signed today, but it's closed to the press. That'll be coming in at 1 o'clock. It'll be interesting to see if he makes comments before or after to the press, especially when it comes to the tariffs today. So keep this one in mind. And you can see we've got a lot of speakers in Europe. ECB Lane, and then Christine Lagarde going to be speaking. Actually, I think she's already done, but if not, we'll be seeing her comments start to come through here in a little bit. We don't have the Spot Gamma Founders note on the AM edition yet. Not really much of a surprise. But we do have a lot of participation in the overnight, looking at 146,000. It's almost a 50% increase from the overnight trading that we saw last week, which was running in the high 90s and 80s. So we have a lot of trading today to the downside here, whether it's, adding to the capitulation or not, don't really know yet. We do have a classic H pattern here, or if we ignore the drop, then we just have a potential for a cup, an inverse cup, I should say, or a double bottom. And the difference between a cup or a double bottom will, to me, be the difference of stopping here where the previous low was or overshooting this low. Matching lows, and then we get that bounce up, usually around a third of the entire distance, and then a continuation to the downside. So that's your inverse cup and handle. As for a double bottom, when we get to the same spot as the other one, overshoot that and then go to the upside. So we're there. We need to see how we resolve this bottom. That'll really sort of line us up on whether or not this is an inverse cup or if it's a double bottom. We are starting the Monday gapped down. Typically a gap down on a Monday is not a good thing, but we're not gapping down from the highs. We're gapping down from the lows. It's worth mentioning the crash situation. I'm not saying we're going to crash, but crashes come from oversold conditions, right? We don't crash from the highs. We crash from the lows, and we're at the lows. Now, we don't have the AM edition yet. So while we have the put wall and we can see it, we're underneath it. We're underneath, zero gamma, volatility trigger. There's nothing down here per se, really, to kind of catch the market and hold us up. That lines up with the idea that we crash from oversold and that we really don't have anything down there. But these levels don't account for the sort of trading we're going to get intraday today, right? We come in with these levels. They're not self-adjusting with the options volume that we're going to get through the day. We are closer to the lower ADR than we are the upper one, which implies we would go ahead and hit that lower ADR. Rule of thumb is if we can hit that, if we hit one side or the other early enough in the day, we can go to the other side by the end of the day. But it's not early in the day. We're already halfway done with the trading day. So if we're going to hit this one and then go to the other one, kind of need to get that done already. The longer we don't do that and just slowly grind down into that area, the less likely it is that after getting there, we'll go to the other side. 55.36 basically is where that line is, and 55.32 cog line is just underneath it. So if we get there, I think if we get that close to a cog line, we'll overshoot it and hit that cog line. Then we need to resolve it, see what we're going to do with it. Once we're past 55.32, then we have 55.11, 5500, 54.92, and then 54.82. This is last week's weekly pivot. This is this week's weekly pivot. You can see how wide that channel is. And we can see that this week's pivot is lower than last week's pivot. The pivot being lower is bearish. Price opening underneath that pivot is also bearish. It's a really wide channel, which implies that if we try to break out this week, it won't stick. But we already are broke out on the week since we closed last week at the lows, and we're just gapped down, continuing the move to the downside at this point. Still, that wide channel does imply that we would go back inside of last week's range by the end of this week. Just keep in mind, these channels don't make price do anything. They are designed to help us better understand what price is most likely to do this week, but it doesn't make price do anything. This day's pivot, much lower than yesterday's. This is Friday's floor pivot. This is today's. You could see lower today, price opened underneath it. That's bearish. So far, we have an MDP. That's a missed daily pivot. We haven't touched it. Generally speaking, markets want to hit their pivot about 80% of the time. So the fact that we haven't hit it implies that we should go up and hit that. That would get the gap closed, and that would very likely line us up to hit the upper ADR red line that I was talking about. That we could go a little lower, hit the lower ADR, begin working our way to the upside, get the gap closed, hit the floor pivot, hit the upper ADR. Just remember, it doesn't owe us that move at this point. If we look around and ask, what the heck is down here since we're so far away from the 200 period moving average? What is next? That would be the 400 period moving average. See right there, 55.94.5. So we hit it back here. We broke completely under it at this point, but we didn't close underneath it last time. And today's not done yet. So we're looking to see if we're going to get that close below this level or not. It's basically, for nice round numbers, it's 5,600, and whether or not we're going to get back above there today or at some point this week. We are at S1. So that does line up with the idea of S1 and then R2. If you've gone through any pivot point trading, this is a pretty common setup. From the floor pivot, you look for an S1 and then a move to R2, or from the other way around, you would look for an R1 for a move into the S2. This is old school. It's very basic. That gets taken off the table if we get below this level and it doesn't hold, and we begin working our way down to the next level, right? Kind of like, say, back here, where we got to S1 and we just cut right through it and kept on falling, and we went to S2 and then we cut through that, and kind of get the idea. We can see they tried to put in a little bit of work at the end of the week. It wasn't enough to hold us, but they sure did try. That's a relatively high amount of volume for the small amount of time that we spent there. If you look at how much time we spent up here and the amount of volume that we had there, so it very likely now is going to be a speed bump or a roadblock for us trying to go back up. We've got a point of control 5650 basically. We cut through that last week, didn't even slow down when we hit it. Otherwise, at this point, not really a lot out here that's going to help us. This does show with the speed that we moved down here, just like we moved really fast through here and it got shallow. We moved really fast through here and it got shallow. Just that little speed bump that I pointed out. So the only good thing about those shallow areas is that if we can move through it easily in one direction, we can move through it easily in the other direction too, right? So if we can get through that speed bump, then we should, in theory, be able to run through this shallow area relatively quickly. Ten-day, 30-minute volume profile. This thing's really not offering any insight for a classic pattern like the D or a 2 distribution or a P lowercase b, nothing like that. We can see some discrepancies in the volume along this area right here. That's what built out all of that volume, but on minimal amount of trades. So those were just really large trades that came in trying to hold us up at the end of the day. Didn't work. We broke down anyways into the close. But that's a little bit of a discrepancy that we can probably see better on the next chart. It's the same thing that we have up here, a whole lot of trades, or a whole lot of volume without a whole lot of trades. The TPO on both of these products are still in line, but we're expecting that to change as we dig through the week. At this point, I still expect this higher level to be the point of control unless we build out a new spot. Because as we lose this from that trading and that little bit of trading there, we're also going to be losing this when we lose all of that, that, and that. That'll also take out the candles that we're working on right now along this low and this. So this one will be gone too. So right now, the base case is 58.20 is where we're going to see the point of control move to. And or 56.20, 56.30, right through here. And that's if between now and then we don't build out another high volume shelf or high volume node along the way. All right, we hit that VPOC 55.89, so that's off the table. It was from the old contract anyways, and either way, we're done with it. And we hit this one, 56.98. We hit that Friday, cut right through it like it wasn't even there. We still have one up here, 57.55. And we built a new one on Friday. 56.24. So if we do make a move to the upside today, we have that VPOC over our head to deal with. You see the significant amount of buying that I was talking about at the end of the day yesterday. All right, we're still 3.7% below the 10-week. We didn't get back to it. We didn't get back above it. We started to expand back in the other direction. We've seen this in the past where we made a run towards the zero but never got there and started to fade. So this is just a continuation below the 10. The 10-week, it's like a really good mean or an average of price. And we want to see it get back above that for any kind of recognition that the market is stable, healthy, healing, adjusting. So the entire time that we stay behind this 10 or stay below it, longs anywhere else in the market are going to suffer, right? If 80% of the market moves the way the S&P and the NASDAQ move, then being under the 10 implies that longs in the S&P and the NASDAQ are going to suffer. So will 80% of anything you try to trade to the upside. So it's not to say you can't find long trades, but the success of those longs is going to be statistically lower. And that's just the way it is when we're in a bear market or in conditions of a bear market. That's why they call it a stock picker's market when we're in that environment. Themes don't generally do as good, and you want to specifically focus on individual companies that are moving to the upside with purpose for a very specific reason. A binary event like news, earnings, insider buying, something specific that's making that one product move. We're more than 2.25% below the 10-day, so we're not as extreme as we've seen in the past, but we're getting to the point where we expect to see this drop to the downside, either get really nasty really fast, which would be that flash crash from the lows that we were talking about earlier, or begin turning around and moving back in the other direction. If we look at where we were down more than 2.25 below the 10-day in the past, it was that August when we had the VIX spike up into 65 and we had some really sharp, swift moves to the downside. Now, there was a lot of different events happening during this time. We had people talk about there was a lot of VIX short sellers that got squeezed there. And of course, if they're short, they have to buy to close, and that added to the buying. And there was a frenzy of buying. And that's one of the reasons that the VIX spiked so high. And of course, VC funds, volatility control funds, they're non-discretionary. If the VIX is spiking that high, they will sell assets like crazy because they're non-discretionary. They don't get to choose. So triggering the VIX like that triggered a bunch of selling. And then we had headlines out of Japan along this same time when it came to Japan and rates and changing things over there. So there was just a whole bunch of reasons why we had this really fantastic sell-off, and it happened really fast. But it was still controlled because it was just mostly tied in with the VIX. This is getting to be a little different. So below this level, things start to get nasty. We were down there in March earlier when you can see here that we got, 3.5% below the 10. And we got there relatively fast. If you look at the weeks in front of that drop, we broke out of the weekly expected move. We closed below it, expanded below it, almost the distance of the entire week's move. And then the next week, the same thing. Now, I know being zoomed in this hard, it's zoomed in this much, it's kind of hard to see. But if we just take the distance of one side, and we expand that down, we moved that entire distance, right? It was a big move. That's not how you would measure a 2 standard deviation, because this range is a 1 standard deviation, but get the idea, right? So it was a big move. We far exceeded what we were supposed to have moved that week to the downside. Same thing with the previous week. So that was 2 weeks in a row where we made really big moves, far exceeding the range that we were supposed to move in a given week. And that's why we got so far below the 10 so fast. And we're back again. Only this time we're at that 2.5 or 2.25%, and we're just starting the week, and we're at a critical key level, and we're not outside the boundaries of our weekly expected move yet. We're just getting started. Tech is at the same spot. It's not quite an H pattern. It's a little more sloppy, but if we look at the low, the March 10, March 11 low, it's where tech was Friday. As for a lot of these others like financials, it's not at that low. Industrials also, building materials, none of these others, maybe healthcare, is close to that low. But that's it. But we know tech is the big one anyways, right? Chips, software, however you want to spread out tech, cloud computing, it is the big one. So if we were going to, look at a flash crash scenario, well, we all know how heavy tech is to the market. So keep your eye on tech and that key level. Looking at the things that are up and down today, biotech, China, semiconductors, the Mag 7, and Bitcoin, which are some of the biggest things that we could have, that generally carry us to the upside and the downside. Well, they're carrying us to the downside right now. Our risk-on sectors are consumer discretionary, which is what we have right here, down more than 1.5. Technology down 1.7, and specifically the Mag 7 down almost 2.5. Alongside with that, the semiconductors specifically also down 2.5%. So these are really big sectors and industries that move the market, carry our market, and drive which direction we go down heavy. So we're not going to stop falling today until they stop falling, and we're not going to rally today no matter how much options flow we get in the S&P or the NASDAQ. If these are continuing to fall, we will not rally. If they stop falling, then we can rally in the indexes, we can rally in the S&P, but we can't go up if they're going down. We also have airlines, financials down 1%. That's another one of our risk on sectors that we need. China, home builders. It would almost be easier just to point at what is up rather than what is down. Gold and bonds are up. And the VIX, of course. So gold miners, silver, surprisingly is not up, which tells us the gold is likely more from tariff talk, war vibes, and that comment about oil in Russia and secondary sanctions. Likely it's due to something like that, because otherwise we should see precious metals collectively, right? Silver, gold miners, all of them being up or down together. So one thing you could focus on today is silver being the outlier. Either gold mean reverts and drops back down again after that new excessive move to the upside, or silver plays catch up really fast and tries to line up with its peers. That doesn't have to happen either way, but I mean, it seems like a layup. Just keep your eye on silver today. If it starts to break out, then you're looking for an inside day breakout, which actually gives you like an inside week breakout. Get above 31.50 for a chance to get into 32, which would be a high, a breakout on the high from last year, October 23rd. Is better than nothing, right? Pot stocks are down the most, which is kind of funny because they've just been bleeding out anyways. Chips, airlines, Bitcoin, consumer discretionary, and then China. But China is down with the rest. It's kind of odd too. We were seeing money flowing back and forth, right? When it was losing, U.S. was losing capital from around the world. It was leaving us. It was going into Europe, into these China tech companies. But now we've got China down and the U.S. down and Europe is down, right? We got basically global down day. But it's like we've talked about before, money doesn't, people don't go to cash in these big funds, these big firms, because they get penalized for it. So they just swap to something else. Bonds, treasuries, commodities, they'll go somewhere. And we see bonds are up this morning. Gold is up this morning. That'll be a good tell to go in the other direction then too. Yields up, gold down, that sort of thing. So this is pervasive. It's across the board. This is what we call a falling tide dropping all boats. If we're going to see a turnaround, then everything has to stop falling and give the S&P and the NASDAQ a chance to run. Some kind of headline news or some shocking news could come out and turn everything higher. It has to be one of those two things, right? %64 of the NASDAQ is down more than 0.5% this morning. That's pretty negative. I've seen it worse than that, but it's been a while since we've seen it worse than that, right? 64% of the NASDAQ 100 is down more than 0.5%. and 65% of the S&P 100 is down more than 0.5%. So we could get into this really nice play. We want a high correlation coefficient, right? I know it's big words really early in the morning. Go to the Visualize tab, change this heat map to an index watch. Now, once you're in here, you can detach these. You can make as many of these as you want, but you can choose these preset indexes. So there's the S&P 100, and you can just scrunch this up nice and small. Keep your eye on the capital. You're looking at money flow here in the indexes. High correlation coefficient, get everything moving in the same direction at the same time. Generally, we see that to the downside, which is not a surprise. If things are really negative like they are today, then everything moves in the same direction, down. No kidding, right? Thanks, Captain Obvious. But if we're going to flip that around, then we would see it in the indexes, everything changing, right? But when it comes to those down days, when you've got a lot of things going down, you play the game the way the algos play it. They trade in a basket. Well, you can trade in a basket too. If you have your own particular basket of stocks picked out and you get a high correlation coefficient, then you trade everything in your basket when you know that you've reached that high correlation. The question is, what's your limit before you say we are at that high correlation number? I like to use 95%. You could use 95. You could be more strict and use 97. You could be less strict and use something like 85 or 90. But if 95 stocks out of 100 are all going down, then you could buy every name in your basket of stocks, buy puts, for an example, and participate in that downside move. Or if we start to flip and run back in the other direction, then you could play your basket of stocks that way. This is a trade plan that I had put together a few years back. It's called the Alpha Protocol. We don't get this scenario very often, right? This really high correlation coefficient. So just keep your eye on the index watch and how many companies are advancing versus how many are declining. And if you get 95, 97, 98 names all going to the downside at the same time, pretty confident in that downside move, right? And you don't have to go in and try to pick and choose. Do I want to short Apple? Do I want to short Google? Maybe I'll do a little Microsoft. You just short the whole basket, everything that is in your basket to short. Keep your eye on the headlines today, guys. That's what I got for you. Be careful, be safe, watch the clock. See y'all tomorrow.